Most investors know index funds work, but they do not all work the same way. Over the past 30 years, the difference between the average index fund and the best performing ones is the difference between turning $10,000 into $175,000 and turning that same $10,000 into $325,000. Same strategy, different index, completely different outcome. Here are 5 index funds with the strongest 30-year track records, ranked by annualized return from the early 90s through today. Every fund in this ranking has a track record going back at least 30 years to 1993. We are using price returns plus reinvested dividends annualized over 3 decades. The benchmark is $10,000 invested in 1993 and left untouched through every crash, every recession, and every recovery. No market timing, no active management, just compounding across 30 full years. We are not including sector funds or leveraged funds. These are broadly diversified index funds that a regular investor could actually hold. The question is simple. If you had picked the right one 30 years ago, what would it have done for you? At number 5 is the Vanguard Total Stock Market Index Fund. It trades as VTSX in mutual fund form and VTI as an exchange-traded fund. This fund tracks the entire US equity market, large caps, mid caps, and small caps together, roughly 4,000 companies in one holding. Over the past 30 years, it has delivered an annualized return of roughly 10% per year. That starting investment of $10,000 would have grown to about $175,000. The appeal of this fund is its breadth. You own everything in the US equity market. If the US economy grows, you participate. If one sector crashes, the rest of the market provides a buffer. The cost is minimal. Vanguard charges around 3 basis points annually, which is essentially zero. For most investors building wealth over decades, this fund alone would have produced an outcome better than the majority of actively managed mutual funds. Those funds often charge 40 to 100 times more in fees. This is not the top performer on this list, but it is the broadest and arguably the most dependable foundation you can own. At number 4 are S&P 500 index funds. You know these names: Vanguard's VFI-EX, Fidelity's FX-EAX, BlackRock's IVV, and Vanguard's exchange-traded fund VOO. These funds track the 500 largest publicly traded companies in the United States. Over 30 years, the S&P 500 has averaged roughly 10.4% per year. That turns $10,000 into approximately $195,000. That is $20,000 more than the total market fund over the same period. Why does a fund with fewer companies slightly outperform the total market? Because the S&P 500 overweights large caps. Large caps have driven a disproportionate share of market returns over the past 3 decades. Companies like Microsoft, Apple, Amazon, and Nvidia have grown to represent a significant portion of total US market capitalization. The S&P 500 concentrates more heavily in these winners. The total market fund dilutes that concentration across thousands of smaller companies that have on average performed less strongly. The difference in annual returns is not dramatic, but over 30 years, even a small advantage compounds into tens of thousands of extra dollars. At number 3 are S&P MidCap 400 index funds. The exchange-traded fund tickers are MDY from State Street and IJH from BlackRock. These funds track 400 mid-sized US companies, not the giants and not the smallest players. The companies sitting roughly between $2 billion and $10 billion in market capitalization. Over 30 years, the MidCap 400 has delivered around 11.4% annually. $10,000 becomes approximately $245,000. That is $50,000 more than the S&P 500 over the same time horizon. This surprises many investors. Mid-cap companies have historically outperformed both large caps and small caps on a risk-adjusted basis over very long periods. The reason is their positioning in the market. They are large enough to survive downturns, access credit markets, and scale operations effectively, but small enough to still have significant growth runway ahead of them. They are not yet the index heavyweights dragged by their own size. They are companies growing into what large caps used to be. This outperformance is not universally guaranteed. There are periods where large caps crush mid caps. But over a 30-year continuous holding period, The mid-cap premium has been real and measurable. At number 2 are S&P SmallCap 600 index funds. The exchange-traded fund tickers are IJR from BlackRock and SCHAA from Schwab. These funds track 600 smaller U.S. companies, with market caps roughly between $300 million and $2 billion. Over 30 years, the SmallCap 600 has delivered around 11.8% annually. $10,000 grows to approximately $270,000. The SmallCap premium is one of the most documented phenomena in academic finance. Smaller companies carry more risk. They are less liquid, more sensitive to economic downturns, and more likely to fail outright. Investors demand higher returns for accepting that additional risk. Over very long time horizons, that premium shows up in the data. The key word is long. In a given decade, small caps can significantly underperform large caps. From 2000 through 2009, small caps fell behind the broader market. From 2010 through 2020, large caps dominated again. But over 30 continuous years, the small cap premium has historically rewarded patient investors who stayed the course. The S&P SmallCap 600 has a structural advantage over broader small cap indices. It screens for financial quality, requiring companies to be profitable to be included. That screen alone has historically reduced the drag from the worst-performing small-cap stocks that weigh down less selective indices. At number 1 is the Nasdaq 100. It trades as QQQ from Invesco and FNCMX as a mutual fund. The Nasdaq 100 tracks the 100 largest non-financial companies listed on the Nasdaq exchange. It is heavily weighted toward technology. Microsoft, Apple, Nvidia, Meta, Amazon, Alphabet. Over 30 years, the Nasdaq 100 has delivered an annualized return of roughly 12.5%. $10,000 becomes approximately $325,000. That is more than 3 times what the total stock market produced over the same period. But before celebrating, there is a number you need to hear. In the dot-com crash from March 2000 through October 2002, the Nasdaq 100 fell 83%. If you put in $100,000 at the peak in early 2000, your account was worth about $17,000 2 years later. Recovery did not come until around 2015. That is a 15-year wait to get back to even. The 30-year return is exceptional, but the path was extraordinarily violent. For investors who held continuously and never sold during that collapse, the outcome was remarkable. For the majority who panicked and exited, it was a disaster. The Nasdaq 100 rewards conviction and punishes fear more severely than any other fund on this list. Here is the full picture across all 5 funds. The total stock market fund averaged 10% annually. Starting with 10,000, you end with about 175,000. The S&P 500 averaged 10.4% annually. That same 10,000 grows to roughly 195,000. The MidCap 400 averaged 11.4% annually. That produces approximately 245,000. The SmallCap 600 averaged 11.8% annually. That grows to roughly 270,000. The Nasdaq 100 averaged 12.5% annually. That turns 10,000 into approximately 325,000. The spread between the lowest and highest performer is 2.5 percentage points per year. That sounds small, but maintained over 30 years, it produces an outcome $150,000 larger from the same initial investment. That is the compounding effect operating at full scale. A small rate advantage, held long enough, creates outcomes that look dramatic in retrospect. What matters more than fund selection are the 2 factors every investor controls: starting amount and time in the market. The investor who put $20,000 into the total stock market fund 30 years ago ends up with roughly $350,000, more than the investor who put $10,000 into the Nasdaq 100. The best fund with the worst timing still loses to an average fund with early commitment. These returns are historical. Past performance does not predict future results. The next 30 years will have different winners. The Nasdaq 100 may not lead. Small caps may outperform. No one knows in advance. What we do know is that low-cost broad index funds, held for decades without interruption, have consistently outperformed the vast majority of active strategies over long measurement periods. The specific index matters less than the decision to hold. If you found this useful, subscribe. New simulations and breakdowns every week. If you want to see how your specific fund allocation would have performed over different 30-year windows, drop a comment below. Sources are listed in the description.